This quick little video is on the tax consequences of retirement accounts. A retirement account is a nest egg, a savings account specifically designed to fund your retirement. Anybody can set up a retirement nest egg at any time. However, there are certain retirement accounts that are officially recognized by the IRS and provide tax benefits. We'll discuss the concept and uses of these IRS-recognized retirement accounts when we get to Module 10, Retirement. However, in this module on taxes, we'll focus on the tax consequence of contributing to the various retirement accounts that the federal government officially recognizes. Obviously, you can start a retirement account that has absolutely nothing to do with the government. Investing in stocks, bonds, mutual funds, certificates of deposit, money market accounts, even passbook savings accounts are available to the individual investor starting a nest egg for retirement. With these accounts, the income that you deposit is taxed, meaning that you start with less. Your realized returns, and that would be your interest income, your dividends, capital gains distributions, those are also taxed. And as a result, the rate at which your nest egg compounds will be pretty low. Returns from investment are realized when you receive them as money, whether cash, deposits into your checking account, or simply reinvested back into your retirement account. Unrealized returns are just paper returns. For example, suppose I purchased 100 shares of XYZ Corporation stock for $5 a share in year 1. By year 2, the price had risen to $6 a share. I would have a gain of $1 per share, or in this case, a total gain of $100. Those gains are unrealized while they are still simply paper gains. It is not realized until I sell it for $6 a share and take those profits. If in the meantime that stock paid me, say, $20 in dividends, those dividends would be realized gains. Even if I didn't take the dividends in cash or have them deposited into my checking account, but just reinvested back into the company, the dividends would still be considered realized and I'd owe taxes on them. These officially recognized retirement accounts can be divided into two categories. One set of retirement accounts are those that are set up by your employer. The other is that set of retirement accounts that are set up on your own. The two most well-known and frequently utilized employer-sponsored retirement accounts are the 401k and the 403b. These numbers and letters refer to paragraphs and subsections of the tax code. The 401k is a retirement account provided by your for-profit employer, and the 403b is provided by a nonprofit employer such as the Salvation Army or the Red Cross. With the traditional employer-sponsored retirement accounts, contributions are deposited before they are taxed, which means that you're depositing more than you otherwise would. Also, returns can be reinvested without being taxed, which allows for the compounded growth rate of the account to be higher. Now, when you withdraw the money from the account to help finance your retirement, those withdrawals are taxed at your highest marginal tax rate. Not the highest marginal tax rate, your highest marginal tax rate. And if you withdraw the money before age 59 and a half, there's a penalty. With the Roth employer-sponsored retirement accounts, named after Senator William Roth, who played a major role in pushing this legislation through Congress that created this tax benefit, contributions are deposited with taxed income. And then, like the traditional retirement accounts, returns can be reinvested without being taxed. Then, when you withdraw money from the account to help finance your retirement, those withdrawals, unlike the traditional accounts, are untaxed. If you withdraw money before the age of 59 and a half, there's a penalty. The very same rules apply with the traditional and Roth IRAs. With the traditional IRA, you get a tax break for this year. The deposits are not taxed until you withdraw the money from your account when you retire. With the Roth IRA, you deposit taxed money, but the money that you withdraw from your account after you retire is untaxed. In both cases, the returns that you reinvest are untaxed. There's a lot more to know about how to best utilize these retirement accounts and when. For example, which would be best for you, a traditional or a Roth account? We'll get into that and other issues regarding retirement accounts in the module on retirement, Module 10. So here's a summary of what you need to know about the tax consequences of retirement accounts for Test 2. There are two basic types of retirement accounts: a traditional retirement account and the Roth retirement account. Both types of accounts can be set up on your own or provided by your employer. For 2022, the maximum deposit into a 401k plan is $20,500, and for an IRA, it's $6,000, irrespective of it being a traditional or a Roth plan. For the traditional account, you are depositing untaxed money. For the Roth account, you are depositing taxed money. For both the traditional and the Roth accounts, your returns on investment that you reinvest are untaxed. For the traditional accounts, your withdrawals upon retirement are taxed. And for the Roth accounts, your withdrawals upon retirement are untaxed. So really, the only difference between a Roth account and a regular nest egg retirement account that you set up, independent of government, with no special tax benefits, is that with the Roth account, your reinvested returns are untaxed. But with your own savings account, the returns are taxed, whether you reinvest them or receive them in cash. In addition, when you take money out of your own savings account to spend it on whatever, you don't pay taxes on those withdrawals, nor would you pay taxes on those withdrawals with a Roth account. But you do pay taxes on those withdrawals with a traditional IRA or employer-sponsored retirement plan. That's the price you pay for being able to deposit untaxed dollars. Again, we'll cover which type of retirement account works best for you in Module 10. But for now, realize that you should make maxing out your retirement accounts a priority. You may not be able to do it in the first or second year that you get a professional level job, but don't wait too long before you start making these contributions. You'll find that time has a way of slipping by, and there's always something that's tempting to buy with the money that's supposed to fund your retirement. Stay patient and disciplined.